Hello, and welcome to Forex Academy. I'll be your guide for today's session. Before we dive in, I want to share a quick but important disclaimer. The content you're about to see is for educational and informational purposes only. Trading foreign exchange, cryptocurrencies, and other financial instruments carries a high level of risk and may not be suitable for all investors. Past performance does not guarantee future results. The strategies discussed are based on psychological and behavioral principles, not financial advice. You should always conduct your own research and consult with a licensed financial advisor before making any trading decisions. Now, with that out of the way, let's talk about what we're really here for. If you've been trading for any length of time, you already know that the hardest part of this business isn't finding the right entry or the perfect indicator. It's managing yourself when the market turns against you. Today, we're going to build a psychological blueprint that will help you do exactly that. By the end of this course, you will understand why your brain tries to sabotage you during volatility, and more importantly, you'll have a step-by-step framework to stop it. And if you find value in what we cover today, and I believe you will, please do me a favor. Hit that like button, share this with someone who needs it, subscribe to the channel, and turn on the notification bell so you never miss a session. Let's get to work. This course is structured into 5 modules. Notice what it is not. This is not a course on technical analysis. There will be no moving averages, no Fibonacci retracements, no chart patterns. Instead, we're going to look at the internal environment. We're going to confront the enemy within, emotional sabotage. We'll start with the neurochemistry of trading, why your body reacts before your mind can think. Then we'll move to an impulse audit, where you'll map your own unique reactions to stress. From there, we'll build a framework for disciplined execution, learn how to transform volatility from a threat into an opportunity, and finally, we'll tie it all together with a practical execution framework you can use every single day. 5 modules, 1 mission, to eliminate the emotional decisions that drain your account. Let's begin. Module 1. This is where we lay the foundation. If you want to master your emotions, you first have to understand where those emotions come from. And I'm not talking about vague concepts like fear or greed. I'm talking about the biological hardware inside your skull. Because the truth is, your brain did not evolve to trade. It evolved to keep you alive on the savannah. And when a red candle appears, your brain treats it like a predator. In this module, we're going to see exactly how that happens and what to do about it. Let's meet the 2 key players inside your head. First, the amygdala. Think of this as your brain smoke detector. It's incredibly fast. It can process a threat in just 0.03 seconds. That's faster than you can consciously register what's happening on your screen. When that sudden red candle appears, your amygdala fires instantly, triggering the fight or flight response. Now, contrast that with your prefrontal cortex, or PFC. This is your brain CEO. It handles rational planning, impulse control, and strategic thinking. The problem? It takes about half a second to a full second to come online. So here's the critical gap. By the time your rational brain wakes up, your primal brain has already hijacked the system. You're not thinking when you see that candle. You're reacting. That's what psychologist Daniel Goleman called an amygdala hijack. The key takeaway here is simple but profound. I'm not my first reaction. Your first instinct to sell or buy is not a strategy. It's a biological artifact. And the first tool we use to counter this is the 60-second no-click rule. After any major price swing, you step away from the mouse. You do nothing for 1 full minute. That's not hesitation. That's giving your prefrontal cortex time to come back online. Let's walk through that hijack step by step, because seeing it laid out helps you recognize it in real time. Step 1, the trigger. A red candle appears, or an alert sounds, where you see your portfolio drop by 5%. In 0.03 seconds, your amygdala registers a threat before you're even consciously aware of what happened. Step 2, the hijack. The amygdala fires. Adrenaline floods your system. Your prefrontal cortex, your rational CEO, goes offline. You're now operating on pure survival instinct. This is not a state for making strategic decisions. Step 3, the reaction. You feel the overwhelming urge to act. Sell now. Close everything. Get out. But here's what you need to understand. That impulse is not insight. It's a biological reflex. So again, the application is the 60-second rule. You institutionalize it. You make it a non-negotiable part of your trading routine. You do not click. You wait. That pause is the single most powerful tool you have to break the hijack. Now, let's zoom in on the specific chemicals that drive our behavior. I call this the hormonal trio, and each one plays a distinct role in how we trade under stress. First, adrenaline, epinephrine. This is the sell now hormone. It's released immediately when you see a loss. It increases your heart rate, narrows your focus, and creates a sense of urgency. It makes you feel like you have to act right now. This is what causes traders to exit good positions at the worst possible moment. Then there's cortisol, the drawdown spiral hormone. Unlike adrenaline, which is fast and sharp, cortisol builds up over time during prolonged drawdowns. Elevated cortisol impairs your working memory and reduces cognitive flexibility. It makes you risk-averse at exactly the wrong time. A 2018 study in the Proceedings of the National Academy of Sciences found that traders with higher morning cortisol levels made more irrational, risk-averse decisions in the afternoon. Cortisol makes you sell the bottom. Finally, dopamine. This is the winning chemical. It's released during profitable trades, creating that rush of confidence. But a dopamine crash follows a loss, and that crash can trigger revenge trading, the desperate need to win it back. Understand that the desire to revenge trade is not a market analysis. It's a chemical addiction loop. Recognizing these chemicals in your own body is the first step to overriding them. So how do we catch these chemicals before they take over? With a simple physiological audit. Before you execute any trade, I want you to perform a 30-second body scan. Ask yourself, is my jaw clenched? If so, unclench it. Breathe. Are my shoulders raised and tense? Roll them back. Ground yourself. Is my heart pounding? Step away from the screen. You are in an adrenaline state. Do I feel an overwhelming urgency to act now? That urgency is adrenaline, not insight. Do not trust it. Am I replaying a loss from earlier? If you're mentally stuck on a previous trade, your cortisol is elevated. Trading is off for the session. Now, here's a practical tool to bring your physiology back to baseline. Box breathing or extended exhale breathing. Inhale for 4 seconds, then exhale for 6 seconds. This activates the vagus nerve, which signals your nervous system to calm down. It lowers cortisol within about 60 seconds. Make this audit a habit. Do not trade in an adrenaline or cortisol state. Wait until you're calm. The market will be there. Module 2. Now that we understand the biology, we need to map our own personal reactions. Because here's the reality. You cannot manage what you have not measured. Most traders spend their entire careers reacting emotionally without ever stepping back to see their own patterns. In this module, we're going to identify your volatility signature. I'm going to describe 4 distinct patterns of behavior under stress. As I go through them, I want you to be honest with yourself. Which one sounds most like you? First, the paralysis. This trader freezes. They see their stop loss getting hit, but they can't click. They watch the position grow from a manageable loss into a catastrophic one. This pattern is often driven by a fear of regret and an external locus of control, the feeling that the market is doing something to them. Second, the avenger. This trader closes a loss and then immediately enters a new, oversized position to get it back. This is driven by ego and a distorted internal locus of control, the belief that they can force the market to comply. This is revenge trading. Third, the optimizer. This trader micromanages every tick. They tighten stops, move targets, try to squeeze every last dollar out of a trade. They often get stopped out seconds before a reversal. This is driven by a need for certainty and a low tolerance for ambiguity. Fourth, the gambler. This trader doubles down on a losing position. They average in without a plan, hoping for a reversal. This is driven by the sunk cost fallacy and a misunderstanding of probability. Hope is not a strategy. Which one are you? If you're not sure, that's okay. That's why we journal. Let's go deeper on the sunk cost fallacy, because it's one of the most destructive patterns in trading. Why do we hold on to losing positions long after we know we should cut them? It's not a logic error. It's biological. Neuroimaging studies from Carnegie Mellon University show that escalating commitment to a losing position activates brain regions associated with identity. Selling at a loss isn't processed as a business decision. It's processed as an identity failure. It feels like admitting you were wrong, and that hurts. In fact, the pain of realizing a loss is processed in the insula, the same region that processes physical pain. So your brain literally tries to avoid cutting a losing position because it wants to avoid pain. The result is a loop. The longer you hold, the harder it becomes to exit, regardless of logic. So what's the antidote? 2 tools. Pre-commitment. Your stop loss is not a price level. It's a pre-made decision. Reframe it. I'm not selling a loss. I am closing a hypothesis that was incorrect. That shift from identity to hypothesis is huge. The outsider frame. Ask yourself, if I had no position in this asset right now, would I open one based on current conditions? If the answer is no, you must close. This one question breaks the emotional attachment to your sunk cost. Module 3. Now we move from understanding our impulses to actually overriding them with a system. This is where we replace primal fear with disciplined execution. And the first concept we need to embrace is something that separates consistent traders from everyone else. Here's a fundamental truth. The market is a probabilistic environment, not a deterministic one. You could do everything right and still lose. You could do everything wrong and still win. And that randomness is what creates the trap. Most traders suffer from outcome bias. They judge a decision based on its result. If they win, they assume it was a good decision. If they lose, they assume it was bad. But this is a cognitive distortion. A winning trade made by breaking your rules reinforces bad behavior. A losing trade made by following your rules is actually a successful trade because it means you executed your plan. What we need instead is process orientation. A process is a set of predefined rules for entry, position sizing, risk management, and exit. And the only metric that matters is your adherence to that process, not the profit or loss of any single trade. That's why I use a trade scorecard. After every trade, I grade myself from 1 to 5 on 3 things. 1. Plan adherence. Did I follow my predefined setup? 2. Risk management. Was my position size correct? Did I place and honor my stop? 3. Emotional state. Did I remain calm and detached? If I score a 5 out of 5 on process, that trade was a success, even if it was a loser. If I score a 1, that trade was a failure, even if it was a winner. This shift in perspective changes everything. Now, let's talk about the single biggest cause of emotional blowups. It's not market volatility. It's position sizing that exceeds your psychological capacity. Here's the principle. If a normal stop out, say a 1% or 2% loss on your account, would cause you emotional distress, anger, or desire to revenge trade, then your position is too large. It doesn't matter what your theoretical risk metrics say. If you can't take the loss without your emotions spiking, your size is wrong. This ties into the concept of anti-fragility, coined by Nassim Nicholas Taleb. An anti-fragile system actually benefits from volatility. A psychologically anti-fragile trader sizes their positions so small that they can view market swings with curiosity and calm, rather than fear and adrenaline. The practical rule is simple. Never risk more than 1% to 2% of your total capital on any single idea. This is not a suggestion. It's the bedrock rule that allows you to survive a string of losses and stay psychologically composed. And before you enter any trade, I want you to apply the sleep test. Ask yourself, if the market closed for the next 3 days and I couldn't monitor this position, would I sleep soundly? If the answer is no, reduce your size by 50%. Repeat until the answer is yes. That's your correct position size. Module 4. This is where we flip the script. Most traders see volatility as the enemy. They want calm, predictable markets. But here's the truth. Volatility is not risk. Volatility is the price of risk. And if you know how to read it, volatility becomes your edge. The first step is learning to distinguish between two very different types of volatility. Structural volatility is the signal. This is volatility caused by scheduled events. FOMC meetings, CPI reports, non-farm payrolls, earnings announcements, or major macroeconomic shifts. This type of volatility is often directional and, most importantly, it can be anticipated. The strategy here is to reduce exposure or tighten stops before the event. You don't react to this volatility. You prepare for it. Then there's tactical volatility, which is mostly noise. This is the intraday price fluctuations driven by algorithms, market makers, and retail emotion. This is the volatility that triggers amygdala hijacks in unprepared traders. The strategy here is simple. Increase your time horizon to filter it out. This is why time frame separation is so critical. Your analytical time frame, say the 4-hour or daily chart, must be separate from your execution time frame. That red candle that triggers panic on the 5-minute chart, zoom out to the daily. It's often completely irrelevant. Zooming out is the easiest way to separate signal from noise. Now let's talk about mindset. There's a fundamental difference between how retail traders view volatility and how professionals view it. The retail mindset is, volatility is dangerous. I must avoid it. Every red candle is a threat. My job is to protect myself from the market. The professional mindset is, volatility is the environment where price moves. I have predefined rules to exploit it. My edge is my calm in the chaos. When you adopt the professional mindset, you start using volatility strategically. First, you reduce leverage. In high volatility environments, your first action should be to reduce or eliminate leverage. A non-leveraged position can weather a 50% drawdown. A 10x leverage position cannot. Second, you increase your time horizon. Shift to strategies that give the market time to work. Intraday trading in high volatility is statistically the most likely to result in emotional exhaustion and account blow-up. Third, you use volatility as an entry signal. A sharp, high-volume sell-off on no fundamental change is often a liquidity event, weak hands being forced to sell. For the disciplined trader with capital reserves, that's not a threat. That's an opportunity. Module 5. This is where we put it all together into a daily operating system. If the previous modules were the theory, this is the practice. A psychological blueprint is useless without a routine to execute it. So let's build that routine step by step. The moments before the market opens are when your rational brain must be fully engaged. This is your daily operating system, and it takes just 10 minutes. Minute 0 to 2, state check. Assess your sleep, hydration, and emotional state. If you're angry, tired, or stressed, cancel the session. The market will be there tomorrow. Trading when you're compromised is not discipline. It's self-sabotage. Minute 2 to 7, market narrative. Identify the key levels, scheduled news events, and the prevailing macro context. Write down your hypothesis. If X happens, I will do Y. This anchors your thinking and rationality. Minute 7 to 9, risk budgeting. Confirm your daily loss limit. For example, twice your average daily risk. And here's the rule. Hit the limit, trading stops. No exceptions. No one more trade. That one more trade is where accounts get blown. Minute 9 to 10, setup selection. Identify only the setups that match your predefined criteria. If none exist, the plan is to do nothing. And let me be clear, doing nothing is a valid position. It's often the most profitable one. Once you're in a trade, your goal is to remove the amygdala from the decision loop. The way you do that is with set and forget stops. Always use a hard stop loss, a broker level order, not a mental one. If you are unwilling to set a hard stop, you are not trading. You are gambling. The hard stop is your commitment to your plan. Now, here's the decision ladder. When price moves, you ask yourself a series of questions. 1. Is the price at my stop? If yes, exit immediately. No analysis. No hesitation. 2. Is the price at my target? If yes, take profits according to plan. 3. Is the price moving within the expected range? If yes, do nothing. Silence the urge to micromanage. 4. Is the price moving against me but not at my stop? This is the danger zone. Here, you do not add to a loser. You refer to your predefined plan. If the plan had no provision for this scenario, you do nothing. This ladder removes the guesswork. It replaces emotional reaction with mechanical execution. Without a debrief, you are doomed to repeat your emotional mistakes. The market is an unforgiving teacher, and the debrief is how you actually learn the lesson. Here's my debrief structure, and I recommend you adopt something similar. Step 1. Process score. Grade yourself 1 to 5 on plan adherence. This is your only real performance metric. Step 2. Emotional journal. Write down what emotions arose, what triggered them, and whether you acted on them. For example, felt panic when price broke below the volume-weighted average price, VWAP. I did not act. I observed. The panic subsided. Price recovered. Step 3. 1 adjustment. Identify just one actionable improvement for the next session. Not 10 things. 1. I will reduce size by 25% tomorrow to account for increased volatility. One change, executed consistently, changes everything. Step 4. Accountability. Review your debrief with a trading partner or mentor. The act of articulation solidifies the lesson. When you say your mistakes out loud, you can no longer hide from them. So let's bring it all together. In an industry obsessed with finding the perfect indicator or the secret strategy, here's the truth. The only enduring, non-arbitrageable edge is psychological discipline. Every piece of market information is available to every participant at the same time. The difference between the consistent winner and the eventual loser is not what they know. It's how they behave when they know it. We've covered 3 pillars today. 1. Master the biology. Recognize the amygdala hijack. Perform the physiological audit. Breathe. Your first reaction is not your strategy. 2. Audit your impulses. Know your volatility signature. Reframe the stop loss. Use the outsider frame. Measure, then manage. 3. Execute the framework. Pre-market routine. In-trade protocol. Post-market debrief. Process score over P&L. Every single day. And here's the final principle. The goal is not to become a robot. You will still feel fear. You will still feel the surge of adrenaline. The goal is to feel it, acknowledge it, and choose to execute your plan anyway. That is the blueprint. That is mastery. Thank you so much for investing your time with me today. I know your time is valuable, and I don't take it for granted. I want to leave you with one of my favorite quotes from Mark Douglas, who wrote Trading in the Zone. He said, "The consistency you seek is in your mind, not in the markets." If you found value in this session, please do 3 things for me. Like this video so others know it's worth their time. Share it with a fellow trader who's struggling with the emotional side of the game. And if you haven't already, subscribe and turn on the notification bell so you never miss a future session. We have a lot more to cover, and I'd love to have you along for the journey. Until next time, trade with discipline, protect your capital, and master your mind. Take care.